Good evening, ladies and gentlemen. This is Barry Norman on behalf of Alvexo and Investing.com, and welcome to our webinar on fundamental analysis. Now, tonight's class is sponsored by Alvexo, one of the world's leading Forex and CFD providers. Alvexo is regulated all around the globe, so anywhere that you're using their services, you know you're under the regulation of the local regulator, the local government, and you know all of your funds are segregated and secure. Now, when you trade with Alvexo, you have an option of trading with their web trader, which is one of the world's leading online platforms with very high execution speeds, incredible security, real-time quotes, and all types of order entry types that you could possibly want to help increase your trading success. You can also download their MetaTrader 4 platform, the world's most popular and powerful trading platform. It gives you multiple order execution types, chart-based trading, market. It's the safest platform in the marketplace, and it also helps you build alerts and signals, and you can also automate some of your trading by setting up your own little robotic system right on the platform. But you decide what you want to do. They also provide all of their traders free signals twice a day, and their signals have up to an 88% accuracy, and they're provided to all of their traders free of charge. You get great customer service, you get up to 300-to-1 leverage, you get a full array of analytic tools, you have access to the Alvexo Trading Academy, as well as their award-winning platform. So if you take a minute, you can go to www.alvexo.com and set up a demo account while we're in class and follow along using their economics calendar. Now today we're going to be talking about how to use fundamental analysis. Now before we get started, let me tell you the class is being recorded. If you wish to see a recorded version of this class, you can go in about 24 hours to www.investing.com, you know, where you signed up for the webinar, and go under the education or the webinar section and look for webinars on demand. And you can see all of our pre-recorded, all of our recorded classes from our previous webinars. And like I said, this one should be up there in about 24 hours after the class. Now, fundamental analysis is a method for evaluating a security in an attempt to measure its value by examining related economic, financial, or other qualitative and quantitative factors. Fundamental analysts study anything that can affect the security's value, including macroeconomic factors such as the overall economy and industry conditions, and macroeconomic factors such as financial conditions and company management. So whether you're trading Forex, whether you're trading CFDs, whether you're trading stocks, fundamental analysis is using things that we understand. Okay, economic results, news and headlines, quarterly earnings statements, changes in CEOs, changes in board management, purchases and sales of a company, estimated sales growth, or lawsuits, can all affect the value of an asset. And all of this type of analysis comes under the term of fundamental analysis. Now, granted, you look at different forms of fundamental analysis depending on the market you're looking at. But if you're looking at a stock, say Apple, and Apple Watches sales go through the roof and Apple computers are going through the roof, you would expect Apple price to go up. But what if an economic factor came out that affected the economy? You know, interest rates go down or go up. It also has an effect on Apple, because the more Apple borrows, the more their debt costs to service. Or like Apple is selling Apple bonds. Okay, they're raising capital, and they're selling bonds at a very low interest rate, because interest rates are very low because they don't need the cash. But it allows them to accumulate cash today at a low interest, so that if rates go up, they still have tons of cash, so that they don't need to go into the marketplace and borrow. Okay? So all of these things have effects on assets that you can understand. It's not like technical analysis that uses numeric values, algorithms, mathematical calculations. This is straightforward information. Granted, you have to go through it all, you have to find it all, you have to understand it. When a company issues their earnings statement, you have to know every part of that earnings statement and understand what it means and why you would analyze it. Like, for instance, last quarter, Walmart sales were way down, so you would have thought their stock would have fallen. But if you looked at all of the data from their earnings statement, you saw their online sales were skyrocketing. And this is where the markets are looking for it to go, because we're looking at growth in online sales. So they didn't care the same store sales were down a little bit. What was important is the online sales were growing faster than industry norms. So fundamental analysis studies everything from the overall economy and industry conditions to the financial condition and management of companies. Technical analysis is the evaluation of securities by the means of studying statistics generated by market activity, such as past prices and volume. Now, fundamental analysis uses real public data in the evaluation of securities price. Although most analysts use fundamental analysis to value stocks, this method of evaluation can also be used for just about any type of security. For example, an investor can perform fundamental analysis on a bond's value by looking at the economic factors such as interest rates or the overall state of the economy. He can also look at information about the bond issuer, such as potential changes in credit ratings. For stocks and equity instruments, this method uses revenues, earnings, future growth, return on equity, profit margins, and other data to determine a company's underlying value and potential for future growth. In stocks, fundamental analysis focuses on financial statements of a company being evaluated. Now, financial analysis is built on the idea that the market may price a security wrong from time to time. Profits can be made by finding underpriced assets and waiting for the market to adjust to the valuation of a company. By analyzing the financial reports from companies or from economies, you will get an understanding of the value of different assets and understand the pricing in the markets. Now, the biggest drawback with fundamental analysis is that when you're trading, especially when we're trading CFDs and Forex, the fundamentals can help you determine whether an asset's going to go up or down. Well, that's not so difficult, but it can help you with entry points and exit points, where to put your stop losses, where to put your take profits, because fundamental analysis doesn't evaluate where a stock is coming from, the volatility in the market. It doesn't evaluate any of this. It only helps you determine what the level of that asset should be. So after analyzing these factors, you have a better understanding of whether the price of a security is undervalued or overvalued at the current market price. Fundamental analysis is also performed on sector basis and in the economy as a whole. Now, there are different data types for different markets. Now, you cannot look just at an economics calendar thinking about Forex or gold prices and not look at it how it would affect stock markets. Okay, if today we got an excellent report out of the U.S. on existing home sales. They surged. Okay, much bigger growth in existing home sales. Okay, so what do we know from that? We can think off the top of our bat, it should help the dollar. Okay, but do you stop and think it will affect the share prices of what shares, what sector of the market? Okay, will be mostly the DIY home builders, not the construction companies building new homes. But when you have a huge volume of existing home sales, you have lots of renovation, lots of touch-up, lots of repaint. Okay, people are fixing them up to resell them, or people are buying them and fixing them up once they moved in. So this helps places like Home Depot, anywhere that's selling DIY equipment. It helps general contractors who are in the business of renovation. So these stocks would have boomed from this. So for a fundamental analyst, the market price of a stock tends to move towards its intrinsic value, which is the true value of a company as calculated by its fundamentals. If the market value does not match the true value of the company, this is where an investment opportunity arises. Example of this is that a current market price of a stock is lower than the intrinsic value. The investor should purchase the stock because he expects the stock price to rise and move towards its true value. Alternatively, if the current market price is above the intrinsic price, the stock is considered overbought, and an investor sells the stock because he knows that the stock price will fall or move closer to its intrinsic value. To determine the true price of a company's stocks, the following factors need to be considered. So when we look at different types of information or different types of fundamental data for different markets, although we can't neglect how they would affect other markets. So we can't do this blindly. Now, if you're looking at stocks, there are alternative types of investment styles that can be applied to individual stocks, as well as sectors. Investors are commonly characterized these as value stocks, growth stocks, and income stocks. So first you have to determine what area this stock that you're looking at or analyzing would fit. Value investing. Value investing is an investment style that focuses on buying a stock that is undervalued according to its fundamental analysis and hold that stock until it reaches its true value. Accordingly, value stocks are presumed to be traded at a discount to their true value. The interpretation of value investing can differ from investor to investor. Some value investors observe past and present fundamentals without considering much about future growth, while others base their strategy completely on the estimation of future growth and forward-looking fundamentals. Despite the differences, the value investing concept always seeks to buy a stock that is for less than it is worth. Where, on the other hand, we have growth investing. And growth investing uses fundamental analysis to look for stocks that have future growth potential, regardless if they're too high at the moment. Facebook keeps getting higher and higher and higher. But do we care what price we buy a stock, even though it's very, very high, if its growth potential over the near term is very, very good? So growth investing consists of identifying stocks that have exhibited faster than average earnings growth over the previous few years compared to the overall market, and furthermore expected to continue this earning growth in the coming future. Growth stocks are thought to be riskier than average stocks since they usually have a very high PE ratio and pay little or no dividends to their shareholders. On the other hand, if you pick a good growth stock, it has the possibility to multiply in value. Investors are thus willing to pay a higher share price for the stock's future growth potential. Growth investors seek to make capital gains from a higher share price as opposed to receiving dividends payments for income. A growth stock does not pay dividends because the company prefers to reinvest its earnings to keep growing and expanding its business. And then lastly, in stocks, we have the third category, income stocks. Income investing consists of investing or identifying stocks that pay relatively high and regular dividends to their shareholders. Well-established income stocks often have a long history of paying out dividends and a track record of regularly paying increasing dividend ratios in a sign of high-quality income stock. So in these cases, we're just looking for fundamentals that will keep that stock steady. We don't want to see that stock plummet, and we don't want to see that company falling down like we're seeing right now, witnessing with GE, or what we witnessed in the 2007-2008 financial crisis. Look, I had been strictly an income investor because I was looking for a portfolio that was growing in income value because I was getting ready to retire and I needed the income generated in these. So I bought tons of shares of Bank of America because they paid a very healthy, steady dividend, and tons of shares of General Electric. Now, what happened in 2007, 2008, 2009? Because of the financial crisis. Number one, the shares fell, but they also cut their or stopped their dividends. So you got hit in two ways. So one of these, if I had looked at the fundamental factors a lot closer and a lot sooner, I might have gotten out of these. But you see, you buy investor income stocks to hold for a long time. I had a Bank of America for 15 years. So the dividends had outweighed the loss in the stock value. But when you're depending on that for your income, it can have a big effect. So you have to understand what you're looking for in the fundamentals for each type of investing. So in other words, when you're looking for growth investment, even though the fundamentals of that company can remain solid, if their growth level starts to ease down, even though they're a solid company, then you have to reevaluate what you're doing. So when we're looking at stocks, there are 5 key factors we want to look at that all fall in the area of fundamental analysis. One is earnings. The key element of all investors to look at earnings. Before investing in a company, you want to know how much the company, is making in profit. 2, profit margins. Amounts of earnings do not tell the full story. Increasing earnings are good, but if the cost increases more than the revenue, then the profit margin is not improving. The profit margin measures how much the company keeps in earnings out of every dollar of its revenue. This measure is therefore very useful for comparing similar companies within similar industries. Now, what you should do is whenever you're reading a news report on a stock, or you're reading they have their earnings statement, or the CEO's talking, there are 5 key points you should put down on a piece of paper and check them off. Because just because Tim Cook's talking up sales of Apple, if you realize computer sales are falling, or their cost for each Apple is going up, but their revenue isn't going, their sales are going up, but their costs are going up. So they could sell a lot more Apple phones, but their cost is going up, and they can't increase the cost, their sales price high enough. So higher profit margins indicate the company has better control over its cost than its competitors. So we want to look at profit margins, as we mentioned. Okay, that is the second most important thing to look at. The third is return on equity. And you're going to notice as you go through 3, 4, and 5, there are different types of evaluations that cover very basics, but there are different numbers, and you have to make sure that you compare each one of these. An easy example of this is that both Company A and Company B both generate profits of $1 million. But Company A has equity of $10 million, while Company B has equity of $100 million. Well, if you have $100 million in equity, you should be generating a lot more than $1 million profit. So their ROE, which is return on equity, is 10% for the $10 million companies generating $1 million in profit, and only 1% for the company that has $100 million in profit and $100 million in equity. Both had the same profit. Okay. So their ROE would be 10 and 1% respectively, meaning that the Company A is more efficient as it is able to produce the same amount of earnings with 10 times less equity. So return on equity is a financial ratio that does not account for the stock price. And that's very nice because it's a different way to look at the situation. Since it ignores the price entirely, it is by many thought of as the most important financial measure. It can basically be thought of as the parent ratio that always needs to be considered. Because from here, we go over to price to earnings, the PE number. PE number you see talked about all the time. All the reports you see out will always have a column for PE. Okay. When taking the current market price into consideration, the most popular ratio is price to earnings ratio. As the name suggests, it is the current market price divided by its earnings price, or earnings price per share, it's EPS. That's another thing we always want to look at. It is an easy way to get a quick look at the stock's value, because this helps you see what the stock's value is as compared to its overall market. A high PE indicates that the stock is priced relatively high to its earnings, and companies with a higher PE therefore seem more expensive. However, this measure, as well as other financial ratios, need to be compared to similar companies within the same sector or to its own historical PE. So in other words, you can't take a PE ratio that fits telecom companies and say, oh, look at that, here's Walmart and its PE ratio isn't as good. You've got to look at the PE ratio based on sectors and in its competitors. You also can't take and look at the PE ratio of Walmart and Target and then compare them to a small little retail operation. Some company that's got just 200 stores. This ratio does not tell the full story since it does not account for growth. Normally, companies with the high earnings growth are traded at higher PE values than companies with more moderate growth. So you have to make sure you're comparing apples to apples. Okay. In order to account for growth, the PE ratio can be modified into the price per earnings to growth, or the PEG ratio. A PEG ratio is calculated by dividing the stock's PE ratio by its expected 12-month growth rate. So there are fine ways to break this down, but 5 in our list of our little task list or little checklist is price to book, PB ratio. It is used to compare a stock market's value to its book value. It can be calculated as the current share price divided to the book value share price according to previous financial statements. In a broader sense, it can also be calculated as the total market capitalization of the company divided by the shareholders' equity. Now, stocks as well as Forex market are affected also, though, by economics data. One of the most interesting trading strategies that Forex traders commonly employ is trading on economic news releases, specifically closely watching economic news items such as the United States non-farm payroll report, which we get the first Friday of the month. The gross domestic product numbers tend to result in significant reactions in the Forex market, especially if they differ substantially from the market's previous expectations. News and economic data are main drivers of market developments, but in a little different way than many traders think. While many novice traders expect important economic events and news events to be reflected on the price immediately, they complain about the irrationality of the market when that doesn't occur and protest that trading the news is impossible. In fact, it is possible and extremely lucrative in the long term if one is willing to wait for the payback to arrive. The market's reaction to any type of data is unpredictable. Now, each country around the world releases its own economics data. And the fact is, if you want to be a successful trader, you've got to understand what assets are affected by specific economic data releases, what you expect, how to read them, and what they will have an effect on the markets, or what they're trying to tell you. So there are many factors that affect the exchange rate, whether you're trading Forex or commodities rate or anything you're trading with CFDs. But you have to understand what these groups are, because every country around the world releases the same data. Okay. Now, there's lots of other stuff coming out, but these are the primary ones that will affect the value of the asset and in trading. We have inflation, we have interest rates, we have public debt, we have political stability and economic performance, terms of trade, and current account deficit. Now, the biggest one is inflation rates. Changes in market inflations cause changes in currency exchange rates. A country with a lower inflation rate than another country will see an appreciation in the value of its currency. The prices of goods and services increase at a slower rate where the inflation is low. A country with a consistently low inflation rate exhibits a rise in currency value, while a country with a higher inflation rate typically sees depreciation in its currency, and it's usually occupied or accompanied by higher interest rates. Now, we have seen inflation in all the headlines for the last couple years because even though the statement I just gave you is the general assumption, during the economic crisis, we saw inflation move into negative rates, which is deflation or depression. So now we're trying to see if we can get inflation around the globe to start moving upward. Okay, because we are at low inflation. Okay, when you have low inflation, okay, there's a difference between low inflation, which is lower than the you need. Okay, the markets need about, or the economies need about 2% inflation, because you have to have inflation to allow manufacturers to increase prices, to have wage growth for the cycle to turn. Otherwise, it's just stagnant. So we consider high inflation climbing above 2%. Low inflation is just 2%, close to 2%, right under it, which is acceptable, but it keeps your currency value. Once you get down to zero or negative numbers, it has an adverse effect. So you have to understand how inflation rates affect the economy and the value of an asset. Then we go to interest rates. Changes in interest rates affect currency values and dollar exchange rates. Forex rates, interest rates, and inflation rates are all correlated. Increases in interest rates cause a country's currency to appreciate because higher interest rates provide higher rates to lenders, thereby attracting more foreign capital, which causes a rise in the exchange rate. Because just because your interest rate goes up that you're offering from the Federal Reserve, it causes your bank rates to go up, it causes mortgage rates to go up, credit card rates to go up, but it also increases bond prices. So that means foreign investors will start buying into your country, or they'll start buying assets in your country. So it is important to watch inflation rates. Okay. Then we also have a current account or balance of payments. A country's current account reflects balance of trade and earnings on foreign investment. It consists of total number of transactions, including its exports, imports, debt, etc. A deficit in the current account due to spending more of its currency on importing goods than it is earning through the sale of exports causes depreciation. Balance of payments fluctuates exchange rates of its domestic currency. So we've all been watching our loudmouth U.S. President, Mr. Donald Trump, talking about being taken advantage of in trade deals and trying to change all the trade deals. It's because a big portion of this affects the U.S.'s current account and balance of payments. And so he's trying to get he's trying to move them back. He would like to see less imports coming in the U.S. and more exports going out. Okay. Then government debt is crucially important. Most people ignored government debt. Okay. It wasn't a number. Yes, if you're a big investor, you're a hedge fund, yes, you watched it very closely, but traders on the whole ignored it. But we learned big lessons about it in the last year or two, watching Greece and the negotiating with the, all the world powers, the EU, the ECB, taking haircuts on bonds. Okay, we're watching things develop. Where's it? Venezuela, Argentina, whatever's going bust now. Okay, the government debt is worrisome and has a big effect on the currency values around the globe, because if a country's debt is less than is worrisome, okay, it can lead to inflation. Foreign investors will sell their bonds in the open market to get out of owning these governments, because big hedge funds they buy these bonds, okay, or big investors or pension funds buy these bonds because they're supposed to be stable, because they would like to see 2%, 3%, or even less than that, in steady income returns. But when a government debt gets too high, they have to worry about this, or the country has a difficult time selling its bonds in the open market to raise their cash that they need to operate their country. So we need to watch government debt. And then we have terms of sale. Related to current accounts and balance of payments, the terms of sale, or the terms of trade, is a ratio of exports to imports. A country's terms of trade improves if its export prices rise at a greater rate than its import prices. The result is higher revenue, which causes a higher demand for the country's currency and an increase in its currency value. This results in the appreciation of the exchange rate. Now, when all of this data comes out, there are market reactions. During news releases, a number of speculators will react immediately, hoping to gain a quick profit and exit. These will create a very brief ballooning of spreads and volume in the immediate term, but also will distort the underlying technical pictures greatly. As these initial buyers and sellers exit, momentum traders will attempt to join in and fuel a more substantial short-term trend with their actions. Depending on the time and the liquidity in the market, they may well be successful, but sometimes they too are checked by previous unknown orders layers that check the advance of prices. When these absorb the momentum traders, the short-term speculative entrants come in, and the initial reaction of the price may be reversed or negated also. So you have all types of reactions, okay? And you have to understand and know how to evaluate not only the report and whether it's better than forecast, worse than forecast, market negative, market positive. You have to be able to evaluate the market's reaction to know where to get into trading. So there are three ways of trading the news, or trading fundamentals, because fundamentals is all about news trading. Now, you can straddle both sides of the market. Some traders position themselves on both sides of the market before a significant lease using a hedge position. Now, we come into these, and they're very important because you have to now know one other thing, and this is called order entry types. Because it's very easy to enter a OCO order, that is, one cancels the other, by setting up orders on either side of the market based on where you expect it to go, where it might go, and what the support and resistance levels are, and how to put your stop losses. And an OCO order is one cancels the other. So you can take a buy order and a sell order, and whichever one gets executed first, the other one's canceled out of the system. And there are many different types of orders that will allow you to profit and be prepared in either way it goes. Then there's ones that will let you, first in, first out, that'll execute the first order, and when that was executed, execute a second. There are many different types of order entries that you can make. And that's why Alvexo is an excellent platform, because they have a very, very extensive list of order entry types. And you have to learn what these are, and you can come. We have classes on all kinds of understanding all the order entry types. You have to understand where to put your stop losses, where you put your take profits, how you would set up these orders, and how many you could set up. But hedging is a great way. So some traders position themselves on both sides of the market before a significant release. They wait for the number to come out and then proceed to trade out of the position. For example, they might take a loss on one side during a post-number correction after having hopefully taken a larger profit on the winning side. This straddle or hedge strategy consists of both going long and short in the same currency pair before the release of the economic data. Action is not taken until after the number is released. Okay? But again, you have to learn this. You can peg, and you have leg trading. Okay? So you can straddle both sides of the market, but these are trading strategies you have to learn, but fit perfectly well when you understand fundamental analysis. Then we have long-term trading. Several academic studies have established that the impact of some news announcements have their immediate impact spread over a period of weeks or months instead of a single day in which the markets are thought to discount them. The non-farm payroll report, or to a greater extent the interest rate decisions of the Federal Reserve, are good examples of this kind of news flow. While the markets react violently and unpredictable in the short term, the mechanisms set up by low interest rates or full employment have consequences that are relevant to many sectors of the economy, and trading them on a long-term basis is certainly possible. The trader who uses this strategy will build up his position slowly and will attach greater value to low-frequency releases, such as GDP reports, and will wait until the overall picture offers clarity before he makes his trading decision. Then we have the short term. To trade the news on short-term basis, the trader must have a clear criterion of what kind of news would justify a trade. Many news traders seek at least a 50% surprise in the data to be considered of the release tradable. The novice trader, in turn, can use the initial period of his trading career for perfecting his money management skills. Trading a news on a short-term basis can be easy and lucrative if the trader is disciplined enough to cut losses, use proper risk management, and accumulate profits. But panic and mood swings and undisciplined methodology can quickly erase all the gains through shocks and volatility. These are various types of indicators which have the potential to cause greater short-term movement in the markets. These are the non-farm payroll report, the interest rate scenarios, and inflation data. So on that note, we've got some better understanding of what falls into this area of fundamental analysis and the different ways you can trade them, the different ways you can look at them. Now you have to adopt a knowledgeable trading strategy. And you can come to our class in Trading the Economics Calendar, where we'll teach you how to build well, first we'll teach you how to read the economics calendar, how to understand what the forecast is, and we'll teach you how to build a trading matrix that takes into effect market positive, market neutral, market negative in a way to evaluate these. But the nice thing about most economic data, okay, whether it's the economics calendar or interest or company earnings, is we know ahead of time what is expected or what the markets are hoping for. We also know exactly when these releases are due to happen. So therefore, we can prepare ourselves and use these, because it's very rare that in the markets you actually know when something's going to have an effect on the markets. What the effect is difficult, but at least you know that there's some effect happening in the markets. So fundamental data can be a great way to understand the markets and decide to trade. But again, without understanding the basic technical analysis, you don't know where to put your stop losses or your take profits. You don't know if an asset's actually overbought or oversold. You don't know what the volatility in the market will be. So when we talk about short-term trading and it can bounce up and bounce down and you need to be on both sides, you need to be able to understand where the support levels are, where the resistance are, read the volume. And all that comes from technical analysis. So make sure you join us for our classes on technical analysis so you understand how to combine the two of these together and hopefully become a successful trader. So thank you very much for joining us tonight. Please go to www.alvexo.com and give them a shot. Set up a demo account in a couple seconds and you'll find out how trading the difference can be so enlightening. You'll see how easy their platform is, all their tools and their analysis types, and all of their education facilities. So once again, thank you very much for joining us tonight. Thank you for being part of the Investing.com family. And remember, you can see a recorded version of this class on Investing.com under webinars or education, on webinars on demand, but you need to give us 24 hours to get it up there. Thank you very much, and once again, thank you for joining us tonight. Good night.